What's up investors, Sneeris here. Today I want to talk about financial metrics and other measurements for the online fashion retailers businesses. Think about ASOS, Boohoo, Shein, Revolve, all these kind of businesses. I want to look at the measurements and I want to put specific focus on ASOS, on which I did a deep dive a few weeks ago, and the video is up. You can see it in my video list. But today I want to look at this next piece that I wrote, which I wrote in a response to a lot of comments that I got on the deep dive that I wrote on ASOS. This is the deep dive, and the video is in my list, as I mentioned. See, it's a very, very deep dive. If you missed it, I really recommend you watch it first and read it first. Link in the description, because it will give you a lot of context about ASOS and what I see in the business. A comment that I got is that I really focused on the qualitative analysis of understanding the business of ASOS and why they have an advantage, and not enough time on the financial metrics. So in this piece and in today's video, I want to go through some of the financial metrics to see why ASOS has been underperforming and why I think this underperformance is only temporary. So it creates an opportunity, an investment opportunity. So before we begin, I want to mention that ASOS had really bad financial metrics since 2018, because in 2018 they started winding up the investment in the new warehouse in the US in Atlanta, and it really didn't go well. It got so bad that a lot of the investment money they put in is just gone without return, and it harms all financial metrics, all the margins, the return on capital, of course, and other things. But this investment, this bad investment, then compounded, of course, because in 2020 we were hit with COVID and then supply chain issues, etc., etc. So it got in a really bad time for ASOS, but it got all the metrics down in a temporary way, in my opinion. And I wrote it here. You can see that my mental model around ASOS is like the Chipotle case that Bill Ackman got into Chipotle, because if you looked at the financial metrics of Chipotle at the time, it was really bad. Sales down, margins down, everything is down really hard. And you might say, okay, this is a business dying. But Bill Ackman genius is that he understood that Chipotle is a great business and that all this financial mess is because of a temporary mistake, and it will be over. And he was right. I hope. I don't think that I'm anywhere close to Bill Ackman, but I hope this is the same case for ASOS, and this is what I see in ASOS right now, with her price really beaten down. Just to give you a little bit of context around it, this is the ASOS stock in the past year. They gone from highs of, this is in pounds because we look at the London listing, they got from 52 pounds all the way down to 13 pounds now. So it's almost 70% drawdown, and it keeps going down. The situation is very bad, at least at the stock price. But I think, again, that the stock price is so low, and too low, considering the strength of the business and the future perspectives. So first thing I want to look at is the operating margins, which is the bottom line of the margins. You can see here in my site, I put an interactive chart. This is the violin chart of many competitors. You can see here ASOS, Zalando, Revolve, Lululemon, and Boohoo. And you can see the operating margins through the years since 2016 to 2022. You can see the spread here. So we can see a lot of things here. Couple of things I want to note that is not immediately clear from this chart is that the latest result from ASOS is the absolute bottom. It's minus 0.2 the last quarter. They posted a loss. And historically, before, if you take the margins before 2016, actually before 2018, when shit hit the fan, you take it in aggregate, you can see that the average is around 4% to 5% margin for ASOS, whereas if you look at the average here, it's 3%. So that's another important point. But we can see a lot of interesting things here, and let's start with the first thing, which is first versus third party products. Basically, when a company sells their own made product, they keep all the margins. There is no other player to take the margins from you. And therefore, companies that create their own product and sell their product have better margins. And I want to focus on three companies first, on Boohoo, Zalando, and ASOS. So Boohoo sells only their own brands, so they have the highest margin. Zalando sells only third-party brands, so they have the lowest margin. You can see it here. So Boohoo is sitting comfortably here below below Lululemon and Revolve. We'll get to them, but above Zalando and above ASOS. And Zalando typically have the lowest, but you can see they have a lot of volatility here for Zalando, but generally they should be lowest. ASOS should be comfortably above them. We took the period of the problematic period for ASOS, so that isn't the clear case here, but that's the thing. And ASOS, as they sell a mix, ASOS sells a mix of 70% third party and 30% own brand. So they have the benefit of a higher margin from selling their own brand, but they lose the relative margin for selling third party brand. You can see this slide from ASOS that I took here. They show how customers get into the shop, get into ASOS, and what is their mix of shopping. So most customers get their foot in the door through their own brand, but you can see here that partner brands have more customers, 11 million customers compared to 4 million customers. So it's a mix, it's still growing, and it's another point in favor of ASOS, in my opinion, because ASOS offering not only their own unique brands, which get people in the door, they're also able to offer partner brands and making ASOS as a one-stop shop for fashion. This is a unique offering of ASOS. I look at it as a competitive advantage, even though it draws down the margins a bit lower. I think it's better for the business, and the total addressable market, therefore, is much larger than a brand selling only third parties and getting hammered on margins and no unique offering, and brand only sells their own things and then missing out on all the customers that want they are impressed with the brand offerings, but they want the known brand, they want Nike, they want additional thing. So ASOS have this advantage, in my opinion. Another point is that the mix of own brands of ASOS, which would lift the margins, is on the rise. You can see it here. ASOS have in their own brand 15% CAGR in the last 3 years, which is and specifically they have star brands, which I talked about in the deep dive, like Collusion, that have massive growth. And so this product mix that should lift the margins is growing healthily on ASOS. The next point I want to talk about is premium brands. If we go back to the chart here, you can see Lululemon and Revolve is way above. And then the interesting question is how can Lululemon pull off at times 30% margin when other companies like ASOS is struggling to get the 5%. So how does it happen? Basically, premium brands. When you sell a premium brand, you can take very high margins, and it's across industry. It's not only on clothing. If you look at the auto industry, you look at Ferrari and Porsche that have 16% profit margin, while Ford stands at 3.5%. Now, that says a lot about the margins. It doesn't say a lot about which business can be bigger and worth more money, therefore. Because, of course, Ferrari and Porsche have higher margins, but when you compare to the wide market that the cheaper, the more affordable cars can reach, like Ford, it doesn't matter that the margins are lower. So that's just some perspective to give to that. And I want to take a look about the numbers that I could pull off from Revolve, because Revolve and ASOS both revealed the numbers of active customers and the number of sales in each period. I could, and you can see it here, I could calculate that Revolve has a revenue of $139 per customer, while ASOS had a revenue of $68 per customer. Revolve didn't sell more products in each purchase for a customer, but they sold comparably the same amount of products, but the products generally cost 2 times as much as they are in ASOS. So understandably, getting the user to the site through marketing and then doing all the fixed cost and things like that, so understandably this premium product is able to get higher margin. So that explains, and Lululemon is crazily higher than Revolve, so that explains the higher margins. There is a lot to say about the premium brands companies and whether they are a good investment. Obviously they are. If you haven't saw, let's take a quick look in case you aren't aware of what Lululemon did in the past 5 years. This is crazy. Let's look at more than 5 years. Yeah. Yeah. So it was a really, really good investment. But in my opinion, right now, their pricing is too high. Their valuation is too high. It has a lot of risk. So it's a different kind of investment. Maybe I will touch on it in a later date. But yeah, their margins are far better, and that explains it when you compare to ASOS. The next thing I want to talk about is the gross margins. Let's take a quick look at the gross margins of ASOS. You can see it here on the screen. It went from, in 2018, in the beginning of 2018, when shit hit the fan, remember I talked about the warehouse in the US, it went from 53% all the way down to today 43%. That's a loss of 10% in the gross margin. Now, it's not all the warehouse. It has a lot of reasons which I expand on here. But basically it began here with the bad warehouse, not just the warehouse in the US, in general, the global expansion. It didn't go well. They didn't took into calculation a lot of the things that it will cost to do this global expansion. So it began to eat on their margins as everything costs more for the company to produce. So it went down and then down again and again. And then at this point, they got hit by the supply chain issues and the inflation, whereas as a company, you always in an inflationary environment are unable to catch up with the costs of making the product and raising the product's prices on the market. So it always eats margins. So that's another effect on ASOS in that regard. Again, that's not something that affects premium brands because by definition they can raise the prices and they actually thrive in an environment like we are now. I don't want to say inflationary environment specifically. So that's two bad things. I want to take a look at what in 2019 annual report, the chair of ASOS, Adam Kozier, he said, over the last few years, the company has prioritized investment in the right infrastructure, in the right places to enable our ambitious growth plans. However, I'm all too aware that this has impacted our financial and operational performance over the last 12 months. The complexity of transitioning to an international scale was underestimated. So, lucky for us, as an investor now, for me, I'm an investor in ASOS, this is all in the past. Back then, they were priced. Let's actually take a look. So if we take a look at the past 5 years, so you see here 2017, 2018, they were priced to perfection because they had massive growth, massive success. And so the price here was way too risky because they need to perform well. Then they didn't perform well. So you see the price drop by half, and then this is March 2020. And then in the corona virus, as it rose, you could see this rise because we have an uplift of sales as every online company had. And then the management shitstorm and everything started to hit. Inflation, the undergrowth of online shopping, so it went down again. So I think that here at this price, it's de-risked. So that's at least my point of view at it. Now to the next thing, let's talk about growth. Here on the screen, this is the chart I published in my deep dive before. I want you to look at the half year data, and let's see at the growth. So you can see that every period we have a modest growth. Of course, this is Corona. This is the craziness here in the UK. But you can see a modest growth. But in the last period, not only there's like 0, 0, 0 everywhere. Move down a bit so you will see it. You can see 0 everywhere, and in the last the last one is the rest of the world. Let's neutralize everything else. So you can see that the rest of the world has a really drawdown of 11, almost 12%. And that's because of shipping costs and supply chain specifically to the rest of the world, which got hit very hard. So that obviously affects the pricing, because everything else basically didn't grow. They kept the same sales, as you can see, but they didn't grow. And the thing that I want to talk about is the online shopping decline. You can see in the report from the UK Office of National Statistics Retail Report. You can see it here. You can read it all. But basically the interesting thing is the proportion of retail sales online fell to 26% in March 2022. Its lowest proportion since February 2020. Continuing a broad downward trend since its peak in February 2021. That's pretty much aligned with what we see here in terms of growth. You see the growth in the start of 2021, which is what we mark as February 2021, massive growth and continued growth of everything else, but now there is a drawdown. Of course, that doesn't explain none of the growth of ASOS. That's attributed to other things that I mentioned, but it explains the headwind that you have here. So there are basically two options that people think about. First is the option of stagflation. It's the scary option that people will buy less in general, and we are in for some sort of depression or something like that. I think that even though this scenario is plausible, I think that it's not relevant long term for a company like ASOS that is focused on e-commerce, because even if the entire pie of retail shopping, of fashion retail shopping, will shrink a little bit, the online shopping part of it is only 20%, and it's growing. Not in the last period, as you saw, it's growing slower, but it's still growing, and the amount of possibilities for such a company to grow, even if the entire pie will shrink for the next 10 years, the company specifically will be able to grow in a healthy way. So that doesn't worry me, even if it happens. The next option, as you can see here, is online shopping mean reversion. People did buy a lot online because of the COVID, because of the closures, all the things like that, and they got tired of it. It's understandable. People spent a lot of money buying things online in the past few years, and they just want to experience other things. I try to prove it empirically by looking at reports and things like that, but it's very problematic. But I think that everyone senses it, that instead of buying another product, you want to go out to a restaurant, you want to go travel, but which you couldn't. You want to do all these kind of things, so it shifts a lot of the money away from online shopping and from shopping in general to experiences. And I think that this the cyclicality of going from here to here is only temporary. Temporary in the sense of it might take another year, another 2 years, but people will go back to the mean and go back to the modest growth of online shopping soon enough, and then ASOS will be profitable from that. And I think that for us, that's another point that creates an opportunity, at least for me as an investor in ASOS, because everyone is running away from e-commerce right now because the numbers are scary. But given that this whole environment is only temporary, it creates a pricing opportunity for me to buy into this market and enjoy the uprise once the mean to reversion will happen. Last thing for today, the return on capital. I would just want to take a quick look at the numbers. So you can see it right now on the screen. The online fashion retailer return to capital with all the companies again, ASOS, Zalando, Revolve, Lululemon, and Boohoo. Let's neutralize the premium companies. And then you can see here that ASOS actually historically, if we look before 2018 when shit hit the fan, and you can see the ROC go way down because the investment in the US warehouse were very massive and got really little return, at least initially. Historically, they had a very good numbers of return on capital, better than their comparable competitors like Boohoo and Zalando, but it went down through this bad investment. And again, I think this is temporary, especially since the warehouse in the US is now much better operationally, and they got over a lot of the issues it had initially. So I think the picture, at least with the US warehouse, will get better. Of course, there are other issues like the supply chain issues right now, the war in the Ukraine that harming the supply chain issues and things like that. It's all obvious risks, but I think they are already priced into the stock, and their ability to rise up from here is much better. So again, this ROC picture of ASOS going down, again, I believe it's temporary, and they will go back to better investments soon enough. They made a mistake with the global expansion. They didn't do it well. I don't know specifically what happened there, but they are getting better in that sense, and we are way ahead in that. Just to give you the full picture, let's look at the premium brands now, Lululemon and Revolve. Let's put Boohoo just for comparison. You can see that they are both much higher, again, for the very same reasons that they are higher in margins. They need to invest less and get more. You invest in creating a warehouse that sells product that sell for twice the price. Of course, your return on this capital investment will be higher. The warehouse is a fixed cost. The products are selling for twice the price while costing less. So yeah, obviously why they have the higher return on capital. And again, this higher return on capital is priced into their stocks. So again, maybe I will talk about premium brands in another video or another article. So that's it, guys. I hope this video was helpful. If you liked it, please leave a like, subscribe to the channel to get more news, and don't forget to visit the link in the description for the full article. See you next time. Bye bye.